I can envision that once the price of gold gets fully reset, and I don't think we're not even close to that. I mean, yeah, I've spoken many times on if you take the uh, the supposed amount of ounces that the U.S. holds and divide it by the debt, only the on books debt, you come up with a number of 135,000. All I'm getting at is the number is much, much, much higher when it gets reset.
We're pushing toward 50. The market's acting stronger than many believed it could or would. And we're seeing pressures like you just mentioned, the SLV, the retail market outside of the United States, and something is definitely going on in the silver market.
The global monetary system is quietly shifting beneath the surface. Confidence in paper assets is fading, while demand for physical metal is accelerating at a pace few anticipated. This isn't just a speculative rush, it's a structural transition. Retail investors worldwide are moving from fiat to tangible assets, with gold and silver leading the way. Backwardation in metals markets and increasing global demand suggest that people no longer trust promises of future delivery, they want their wealth secured now. Meanwhile, institutions are following suit, with major firms like Goldman Sachs now allocating 20% of portfolios to gold, a dramatic break from decades of Wall Street orthodoxy. BillHolter and David Morgan warn that this shift represents more than just market rotation, it's the early stage of a monetary reset. As the price of gold eventually gets revalued against unsustainable global debt, mining companies could return to behaving like utility firms, stable, dividend-rich, and essential. With fiat currencies steadily losing purchasing power, ounces in the ground may soon become the most valuable reserves of all. The next phase of this wealth transfer will belong to those who see it coming before the reset becomes official. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I want to talk a little bit about history, and I'm talking about 100-year-old history. If you go back to the early part of the 1900s, believe it or not, mining companies, because gold was pegged, it was pegged at $20 and then revised up to $35. But because gold was pegged, mining companies were actually, if you want to call them, the original utility companies. They traded like utility companies because they had basically a pretty much a known cash flow. You knew what the costs were, you knew what you were going to get for selling your product, and they paid big, big dividends. And I can envision that once the price of gold gets fully reset, and I don't think we're not even close to that. I mean, I've spoken many times on if you take the supposed amount of ounces that the U.S. holds and divide it by the debt, only the on books debt, you come up with a number of 135,000. All I'm getting at is the number is much, much, much higher when it gets reset. And at that point in time, I think you will see very, very large dividends coming out of the mining sector. Because at that point in time, you'll have pretty much a known sale price for your metal. And I'm assuming that, governments, more than likely China, the BRICS, they're going to set a price. And, the price is going to move a little, going to be like what we've seen in complete free markets. I think that set price, as long as a mining company doesn't go crazy and watches their expenses, I could envision the mining sector again resembling the utility sector. That's just my 2 cents. That's simply, I want my metal and I want it now. I don't want it next month or 3 months or 6 months. I want it now. That's where the buying is, and that's what causes backwardation. What you're seeing worldwide is it's a bank run, except not a bank run. It's a run into metal. It's a run out of paper. I mean, you can look at the US dollar on the USDX, and what is that? That's garbage. You're measuring crap versus crap. But if you measure gold, or even gold, silver, or even a cup of coffee, currencies are quickly losing purchasing power, and that's adding to a lack of confidence in paper. Has come out, not too many people have talked about, is Goldman Sachs going from their typical 60-40 recommendation between stocks and bonds to 60-20-20, 60 stocks, 20 bonds, and 20% gold. I mean, that's got to be heresy on Wall Street, because I mean, during my career on Wall Street, if you said 10%, you were like, that was the absolute most bullish you could be, is say, you should put 10% in gold related assets. And here you got Goldman Sachs saying 60-20-20. And obviously that will create more demand. It looks to me like the redemptions, and I mean, we got a massive redemptions over the last, call it 9 months. I mean, in the last 9 months, I probably got more sellbacks than I did in the prior, call it 15 years combined. And just in the last couple of weeks, and especially in this last week, retail buyers are coming back. And I think I only had maybe a couple sales, 3 sales in the last week. And I mean, there were weeks where I'd get 15, 18, 20 sales in a week. I'm like, holy cow, it's to watch the price keep going higher, but North America be a seller. The one thing I did take away from that is that there's no money on the streets. And I say that because most of the sales were people telling me, I need to sell because I need the money. I'm running out of cash.
Yeah.
And I think there's a lot of other evidence. And you can look at credit, you can look at subprime credit, you can look at autos. Obviously, you look at commercial real estate. Look at Las Vegas. Look at the traffic, the flow in Las Vegas. All of these things point, for me, when I look at them, they point to the same thing, is that there's less and less money on the streets. However, there's more and more money in the system. So it's not getting its way to Main Street. The money that they're creating it's going to Wall Street. It's going to financial assets. They said it's a long time for a fiat currency. Generally, they don't last more than 30 years, but because the dollar was the world's reserve currency, I mean, any time that they throw the dollar overboard and change to a new currency, it will be tumultuous. As far as the mining shares are concerned, and I think it may have been the last interview I did with you, mining shares now are based on they're based on production, based on cash flow.
Yeah.
Historically, I mean, if you go back to 2011, you go back to 1980, you go back to the 80s, 90s, mining companies, there was a value of gold in the ground.
Mm-hmm.
There was a price for value for ounces in the ground. Ounces in the ground now are barely even looked at. And I think that's where we're headed back to again, is that companies are going to be valued based on their reserves. And as long as they have enough cash flow to survive and keep afloat, and even enough cash flow to continue drilling. But I think ounces in the ground are going to mean a lot more in the future than they do right now.
Silver's current behavior suggests something far more profound than just technical momentum. It's showing signs of physical market stress. The steady rise, despite heavy shorting, the backwardation, and the premiums being paid for physical delivery all point to a tightening supply. Retail and institutional buyers alike seem less concerned with paper promises and more focused on securing the real metal. When selling pressure fails to bring prices down, it signals a break in the old structure of control. The paper market is losing its prescience, grip. As silver approaches the $50 mark, the dislocation between paper and physical markets could widen further. Mining stocks, which often lag behind spot prices, may now represent the most asymmetric opportunity in the space. They're priced for silver in the 30s, while the market trades closer to 50, a gap that rarely lasts long. If earnings catch up as expected, this could mark the start of a significant revaluation across the sector. Let's get back to the interview.
We're pushing toward 50. The market's acting stronger than many believed it could or would. and we're seeing pressures like you just mentioned, the SLV, the retail market outside of the United States, and something is definitely going on in the silver market. So moving on from there, what if we're in a situation where the demand for silver blocks physically, supersedes or overrides the paper market, where I don't care how much you short, give me the silver, put up or shut up. I need it and I need it now, and I'm paying a premium for it. Give it to me. We have a delay. And I'm not saying that's what's happening, but it's acting as if something like that is taking place. I don't want to be overly enthusiastic here. I want to try to remain objective and level-headed. But the facts are, as you outlined them so eloquently, we got backwardation, we got retail purchases, we got people shorting the SLV shares and they can't short anymore. What happens when you sell, and it doesn't take the price down? Well, that's kind of what they're doing in the SLV. They're selling as much as they possibly can, and the price is going up. That's a head scratcher. It always worked before. Why isn't it working now? Simplest, easiest, best way to catch up with people that bought silver at 30, 35 is to buy the mining stocks. And why is that? It's because there is a delay. It's like getting a look into the future. And you have a crystal ball, because most of these stocks are priced as if silver's still at 30, and yet silver's at 48 or whatever. And so there's a delay between the stock price of a good silver company and the future's earnings, which we already know ahead of time. Now, we don't know a quarter from now if silver is going to be priced at 48, 58, or 38. But what we do know is the stock's selling for 30, and it's going to be somewhere probably in that range. So the earnings are going to be far higher than what the stock is indicating now. So it's an almost guarantee. I'm not allowed to say guarantee, and there is no guarantee that by buying, if you want to buy silver at 30, 35, buy the underlying shares. It's that simple. I think I said this on your program. If not, if I did, cut me off, but I made a big mistake in the 80s because I got out of gold at a pretty high price, but I sold my miners at the same time, or nearly the same time. And I kicked myself because 6 months later, these gold stocks keep going up and up and up and up. And I go, what's wrong? Well, duh. What happened was gold went from 850, but it settled around, if I remember right, around 600. Well, a year earlier, gold price was 300. So what were the earnings to the bottom line of those gold companies? They're phenomenal. They were just really, really high. So stocks are supposed to move on earnings. I mean, when you buy a stock, you're buying a company. You buy a company to make money. What are the earnings? Are the earnings getting better or worse? They're getting better. The company's more valuable. It's that simple. So the gold stock kept going up and up. And man, what a mistake. I don't plan on making that mistake this time. However, there's more dynamics to it than back then because of the trust of the paper markets altogether. So there's another part of the equation. I want to go there right now. You can ask me, but anyway, that is the answer. And you want to be a little bit careful. There will be a time when the juniors really accelerate. I know a lot of them have done well. Some are on my list. I took one off the list a while back. One of my members called me and said, man, I'm so happy that stock's up 500%. I said, yeah, because, and they are. I mean, some are, some aren't. But anyway, that's the answer. I stress to do it very consciously. You want big money in big companies. You still want, small bets on these smaller companies. And you want to use, you don't want to get lost in the FOMO. You want to do it judiciously, but that's the way to do it. I've been saying it for a long time, and, the run to gold began, whatever it's now been, several months. And, breaking out at the 2000 level was pretty much a guarantee that gold had changed. Changed what? Gold doesn't change. The perception around gold changes. And the perception was that the market at large, with the central bankers being first in or the smartest money, said gold is money and we need more of it. We don't trust the stuff that we call money. And so that move from 2000 to 4000 is based upon an adjustment of perception. Perceiving gold as a safe haven or tradition or a pet rock or a shiny substance or all this negative connotations around gold. The market has proven beyond a shadow of a doubt that gold is the ultimate money. And we have to examine it from a psychological level. And that is, what is the demand for money? And the demand is infinite. I mean, if you take all of the quote unquote money that's in real estate, that's in stocks, it's in bonds, it's in private equity, that's in limited partnerships, that's in mutual funds, that it's in ETFs, it's in options, futures, and all that money that exists wants to go into something that they trust, because the trust in all those other arenas is losing validation. Then you have an infinite demand, basically. So where would that put the price? Well, that's a hypothetical, but it has to do with psychology of markets. And that's what I'm saying. The psychology has changed. Well, what about silver? Well, silver's like, hey, you know, silver acts like gold. It's little brother, it's poor man's gold, whatever, you know, metaphor you want to use, but it's also highly essential with no substitution in almost all cases for a high-tech society. And, you know, how much of the world still needs electricity? I mean, anything that's electrical or electronic requires silver. So you've got that demand on top of a ongoing monetary crisis in quotation marks. It's not at a crisis level yet. It may never get to a crisis level, but the market is signaling a crisis ahead. A big one, a small one, a little one, a one-day event, a one-week event. We come back to quote unquote normal. I don't know. But if we get into that panic mode, then all bets are off. That's when we will go parabolic or double parabolic. And I don't want to see that happen. It's extremely hard to call a top when you start going really fast, really quickly. And that was basically how I called the top in 2011, that was going up so quickly. And again, having that experience about selling in the strength. So I said, this is it. You know, it's a pretty good call. I'm not saying I'm going to get the next one. So I don't think that will happen, Danny. I think we're going to get a pullback. I think we're going to margin up. I think the exchange is going to do everything in their power to kind of quell the markets. And if it goes for weeks or even a couple months, then we'll probably have another conversation. You know, Morgan doesn't know what he's talking about. Danny misled us. Who knows? And I don't really care. I'm doing the best I can. But a consolidation here would actually be healthy. It would actually help the market out to get a bit of a pause, a bit of a rest. But we just don't know. My gut feel is that it's going to go a little higher, maybe hit that 50, 52, 53. I don't know. And then all of a sudden they win, and they do enough with margin requirements to bring the market back down. I mean, I'm doing that based on probability. Every time you've seen a market do a runaway, like palladium did in the early 2000s, they upped the margin requirements to got to be, well, you got to have cash only for a margin account. So in other words, if silver is a 5,000 ounce contract and it's at $50, what is that? 50 times 5,000, 250 grand. Is that right? Do the math right. Anyway, so instead of putting up 10% or putting up 25,000, you got to put up the full amount. You got to put up the full 250K. Well, that's a cash market. So they're forcing the futures market into a cash market. They did that in palladium. And guess what? It wasn't enough. They actually got it above that. So I actually had 4 contracts on in palladium when that took off. And I forget where I bought, but it's like, 200. I have to look. But it was 200, went to 300. And my broker called me and said, you got to put more margin. And more margin, are you kidding? I wanted to buy more. I was thinking, I'm forward a low base. I could add 1 or 2 very conservatively with all the extra cash in my account. It was, oh, no. It doesn't matter. You're winning. You already got all this extra cash in your futures account. The margin requirements are going up across the board, long or short. And I learned that one the hard way. That was, like I said, in the early 2000s. I've been trading futures for quite some time and didn't know that. But that's what can happen. So all I'm saying is caution is here, especially if you're on leverage. If it were me and I was holding any contracts, 110 or 100, I'd be lightening up or getting out for now, taking the cash profits, taking that cash and turning it into physical silver and standing by and wait for a while. Now, if it goes to 60, then having said that to you, I'll get a lot of hate mail. But, being in this game for a long time, it's always good to sell in the strength. Because once you start getting that point where the market does reverse, that's hard to sell. Now you're selling into a lot of sells, which begets more selling. So where are we going? I'll say it again, I'm not sure, but it certainly is acting like it wants to go higher from everything we've talked about from the initiation of our interview.
The silver market is entering a stage where perception and reality are beginning to collide. The structure that once allowed paper traders to dominate is breaking. When futures contracts lose their grip on physical delivery, confidence shifts rapidly, and we may already be seeing that shift play out. Premiums are rising, supply chains are tightening, and investors who once speculated on price are now demanding possession. That's not a sign of hype, it's a sign of transformation. For long-term investors, these moments rarely announce themselves twice. Markets built on leverage and illusion eventually give way to tangible value, and silver stands at that intersection, now a blend of monetary necessity and industrial indispensability. What unfolds next may not be gradual. It could be abrupt, decisive, and unstoppable once momentum builds. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.